This interview is for information only and should not be considered as investment advice or a recommendation to buy shares in the company featured. Welcome to this Stock Box interview.
Well, joining us today is Kieran Moseria, the CEO of Cadence Minerals, following news of the successful completion of its capital expenditure optimization program at the Amapá Iron Ore project, resulting in significant cost savings and increased production. Well, thank you very much for joining us today, Kieran. How are you, first of all?
Good, and yourself?
Yes, very good. Thank you, Kieran. Good to be catching up. I know we've talked about this before. These studies were ongoing. They were progressing well, and you said you were looking the early stages were looking positive, and the Capex could indeed be reduced. So the announcement just recently confirming that, really, and $63.2 million cost saving there on the Capex there. So I mean, that's quite a big cost saving to get us started, isn't it? I mean, why was this well, first of all, how could you identify this, and why was this perhaps not identified before? Because, of course, it was a very significant past-producing plant.
Yeah, and I suppose there's three ways to answer that. The first is that what happens is that, yes, it was a previously producing plant. It used to produce three different types of products, and we've one which was a 58% product, which is a lower value product. So in this part of the study, we wanted to, and which we did beforehand, was we had two products, one 65% iron ore and one 62% iron ore. Both the higher value products, and the 65% gets about a $10 to $20 premium over the $62. So we previously redesigned the plant and got the previous Capex on the plant of around 200 million. So what we did subsequently, so the end of last year, well, actually, after we published the PFS, we were always about optimizing. You know, we said that that's what we want to do. In our interims, we said we want to try and find, if we can, lower Capex, better product mix in terms of those optimization studies. And we've delivered against that in this case. Why is it so low, and why didn't we identify it beforehand? Well, one part of it is that we did a lot of the studies based on Brazilian engineers using Brazilian products. And we didn't take advantage of some of the tax incentives that we could have. We got those tax incentives confirmed, so we were able to get some tax back in relation to that. So that reduced the Capex. And we went out to Chinese manufacturers with a Chinese engineering company who went and quoted the big material items here, which will make a massive difference. So, for example, things like ball mills, there was up to a 40 to 50% saving. So ball mills, one of the largest expenditures that we're going to carry out. Also, the Chinese engineers identified certain areas that we could completely eliminate from our process flow sheet and still get the same product. So, for example, we've completely eliminated the spiral concentrate area, or the spirals completely. So those things, as well as both finding savings in the capital equipment, a slight redesign of the process flow sheet has meant we've been able to deliver these savings. And in essence, that's what PFSs are about. PFSs are about providing the optionality. So you come out with a set of results, and then you go, right, well, how can I find the best way to optimize this to get it, and then either get it to an implementation phase or DFS an implementation phase. That's why you're seeing some variations now, and that's the right thing to do. PFSs identify both opportunities and a rough idea of your economics.
And this cost savings just been identified, because I just remember from last time we spoke, you talked about the Capex being about 200 million. So I guess that's reduced now to, well, about 140 million, something around that area. But that's just for the plant, isn't it?
Yes, that's for the plant. We don't really, and so the overall project was around 400 million. So if you netted off this 60, which is not quite right thing to do, because that was done on a different exchange rate. So beforehand, the exchange rate was 5.5 to the dollar to the real. It's now 5.1. So that's why we haven't quoted it. But at rough and ready numbers, you might knock off 50 million if you take off the overall capex.
Okay.
So it would be closer to 350. We have some other capex savings that we identified in scoping study level, which was early, which is about $28 million saving to the port. But for now, we're focusing on the plant because that's where, and I think that's ultimately what we're going to do. We're now going to do based on these figures, a new economic study in terms of the pre-feasibility study on this area. So it will be the increased production and the capex savings. How does that impact the NPV? Of course, it's going to be a positive impact on the NPV compared to our sort of $1 billion that we had beforehand. So that's what we're doing now. We're engaging with the mining engineers to redo the mining schedule and create that new mine plan.
Okay. And as part of the optimization, did you also identify you increased the throughput as well? Is that right? And you're perhaps targeting now 5.5 million tons per annum?
Yeah, we did. And that is in essence because we've increased the availability, obviously by replacing more of the older equipment. So we've increased the availability and utilization of the plant as a whole. So therefore you get a marginal increase, but it's about a 4-5% increase in production.
Okay.
And as a result of higher throughput, and you've got a fixed cost in essence in the mine, you get a slightly lower cost of production, but nothing material, not worth mentioning.
Okay.
So what this study so far has identified is we've got lower capex, higher throughput, roughly the same cost per ton, and that's a positive outcome.
It is a positive outcome, and I mean, of course, then the next question comes: how does it affect the sort of profitability and the bottom line? But I think the RNS also talked there about the next steps. This is going to form the basis of that PFS, which you've just mentioned earlier there. And from talking last time, you want to get that PFS done, and then in theory start construction really from the PFS, and the DFS will come during the construction process.
Yeah, I mean, we've already published a PFS. What we're doing is updating it to reflect this model, which is effectively a lower capex, higher throughput, and roughly the same cost. So that will impact that model, and we'll publish that once we've done the mining schedule. Because if you've got a higher amount of production coming through, you're going to be mining more out of your mine. So you have to rejig your mining plan, and that needs, that can take about 2 to 3 months of work to do. So that's ongoing, and we'll report that economic study when we get that done. In addition, which is the other thing that we need to be very clear about, this is our plan B of how we want to develop this asset. And what I mean by plan B, it's we're increased production, lower capex, so we should get a better NPV and a better economic and better profitability. But we're really fully committed to get this high grade green iron production. What we do know is the flow sheet works. Now we're going to take samples, and it's 2 tons of samples representative across the whole mine. So it's not just digging up some holes. You have to ensure that you take it off all the key faces, or you've got a representative sample. That goes to China. That gets tested, so see if our flow sheet works. And if it does, and it produces a good product with not too many deleterious elements, i.e. elements that would lower the price, i.e. phosphorus or silica, then we'll utilize that number and that flow sheet to become our plan A.
Okay.
Because an extra going to 67% would add around a $15 premium to our product. And what does that mean? Well, $15, let's even call it a $10 premium to our product, is an extra $55 million to the bottom line of the asset. Yeah. So our plan B is like our fallback plan if the flow sheet doesn't work out. And if the flow sheet works out, then you're going to get a much higher NPV, and that will be the basis of how this project advances.
And that flow sheet is currently in development. When are you expecting to see results from that?
I'm not going to put a forecast on that now. We've already got a flow sheet. We know what it looks like. Now we need to send the samples to China. Well, sample it and send the samples to China. So there are a lot of external factors, export and stuff like that we need to do, and China might take some time to refine that. So I think the main thing is once I have a clear line of sight of when that's going to occur, we'll provide the shareholders with an update. Okay. But in essence, we said we'd get this done in this quarter or in the next 3 months. We got it done earlier. I mean, we intend to try and keep on hitting those targets. And every target that we set in terms of a timeline I set, I want to be able to deliver on it.
And the updated PFS within 2 to 3 months?
It'll be 2 to 3 months to get the mining plan done, and then another 2 to 3 weeks on top of that to get the full economic study around it.
Okay. So a fair few things going on, and in the background, let's say, I know that you've got to get those environmental licenses. You've got two. You've got the installation license, which is for the mine and the rail. You said last time the port needs an additional survey that you're planning to do sort of June. So that's, I guess, going to be kicking off in the summer, and then you can get that operational license. So just give us a sense. What are you working on day to day?
Well, day to day, it's everything from the technical side, which is the optimization, sourcing. For example, we want to source a cheaper mining cost. So we're going out to tender for mining contractors to see if we can reduce that. We think $16 a ton, which is it is at the moment for the mining, is a bit expensive. We might be wrong, but let's go and see if we can improve that by $2 or $3. Every dollar at 5.5 million is $5.5 million of extra revenue. So if we can get our target of an overall cost below 30, let's say 30 below 33, we're going to be in a really good place. So there's the technical side. Then it's, of course, the other side is ensuring that the licenses are going ahead. That's all going fine. We'll be submitting the rail license application in April. And in June, we'll submit the port, and that should mean that all our installation licenses are granted by the end of this year. The other side is, stakeholder engagement, and that includes engaging with both the people that are going to be impacted by this development, the state, at state level, all the various mayors, governors, senators, and also engaging at a federal level. So that we get the backing at a federal level. And on top of that, then there's the financing, which is...
the financing. I'll ask you on the financing at the moment.
So there's many things to do.
Yeah, just on the government thing, the federal level, is that a risk? Do you see any problems with that, with it convincing officials and governments?
No. It's not convincing officials. It's just keeping people engaged and informed. The more people that are informed, when you need to... you don't get questions. So, let's say, when you approach a senator, they know about the project. They're fully informed rather than hearing it through hearsay about someone that might be talking against the project. Or you make sure that they're fully informed, and that's proper stakeholder engagement, so that you get a social license to operate. Indeed. And also, there's possible federal help. So you do get federal tax breaks. You can get federal funding. So all of these things are important to put this jigsaw put together to get it constructed and operated.
Indeed. Well, it sounds like you're on it with everything that needs to be done. Let's just finish on the financing. That's going to be a big one. We hear lots of complaints from companies that the markets are tough. It's difficult to raise capital. Although some companies have managed to get placings away at premiums recently. So I think it perhaps depends on the proposition that you're making to the market there. But I know we talked last time. You said it'd be a mix of equity and debt. You talked about maybe 20% being equity, the rest being debt. But I mean, 350, if that's what it's going to be, roughly speaking, that's a lot of money to raise there. I mean, I guess, first of all, how confident are you that you can actually raise this money? But secondly, what would you perhaps say to shareholders? I'm sure you have their concerns at heart here, who might be thinking, well, should I continue to hold my shares now, or should I sell and come back later when things are more clear? I'm worried about perhaps massive dilution or something that might be coming down the way.
So I think we've been really clear about how we're going to fund this project, and let me reiterate again. The funding for the actual project development, so that is the what is there or thereabouts a $350 million Capex, and is going to occur at the project level, of which the plan is at the moment 80% of that's going to be debt, and the rest and 20% going to be equity. Now, what we're going to do at that, what we've also been clear is what we want to do is to bring in a joint venture partner to fund that. or a private equity group to fund that, or a mining group to fund that, or also the other option is we get completely bought out. But, that is what we're working on. So where does the dilution occur? Well, there is going to be a dilution to Cadence's. Cadence will not be probably going up to its full 49%. And there might be a dilution at the project level, but not at the Cadence equity level. So the idea is, when we've got a market capitalization of 10, which is a substantial discount to the value, or even the book value of this asset, there is little point in raising the equity for the development of the project in Cadence. We'd want to raise it, and the plan is to raise it at the project level. So the idea would be Cadence, Indocino, plus one other that would come in and develop that project, or effectively someone's bought us out, and and Cadence would receive the revenue and the profit from that. So our financing is very much focused at project level, and with that's what we're talking about, whether it be a mixture of debt from traditional EPCM financing, possibly some federal funding for the strategic assets of Amapá, possibly, and that's where we're focusing on that. On the equity, we're talking to both private equity, international private equity groups, mining companies, and also Brazilian equity groups, equity finance groups as well. So we're covering the whole gambit, but you need to do so to get that funding. So for clarity, funding of the project would want to get a JV partner or be bought out, but JV partner if we're still being involved, and that can be private equity, mining company, that sort of thing, and the debt would be funding it as well there. So Cadence's contribution to the equity going forward will be about investing and continuing to develop this asset up to the point of basically construction.
Right. Okay. Which should be occurring in 2025.
So at the end, beginning of 2025.
Yeah. Okay. And early discussions on any kind of financing? How are they looking? Positive?
Oh, they are. They're all looking positive. There's a data room. People are doing their due diligence. And, when we start looking at sort of metrics that people look at, what's your capital intensity? How does that compare to other assets? And as I've highlighted in the announcement, we compare very well to other assets in terms of capital intensity. We're at 50% of the median, so that's very good. Our operational costs, as I said, we want to get that lower, but 35 is also a good operational cost to free on board at our port. But if we can get that closer to 30, that's better. So we understand where the market likes to see it, and we need to make this project more attractive, so that we can, that funding is cheaper, and it's also paid back quicker, because if you get the Capex lower, that means quicker returns to shareholders. So, we're laser focused in, trying to get all our targets delivered this year, which are all about optimization, and then the funding as well.
Okay. Well, thank you very much for your time today, Kieran Moseria, the CEO of Cadence Minerals.
Thank you very much, Mark.
If you enjoyed this interview, then give us a thumbs up, a like or a retweet. Subscribe to us on YouTube or follow us on Twitter, and hit that notification bell to be the first to know when we release new content. There's loads of great content on our website too, across all our programs at stockboxmedia.com. Thank you for watching.